It seems reassuring for sure. I wonder, though, what the implications of that might be for the fact that maybe that means the Fed can and will choose to become more restrictive because it's not creating, these financial accidents or meltdowns or consumer stress elsewhere with its policy. And is that a hazard right now, or do you think that equity valuations have adjusted enough for what the Fed has to do?
So, look, I think we know that equity valuations have adjusted quite a large amount. And as recently as, 10 days ago, we're in fact, viewed a Fed funds rate that was going through the neutral rate. We were pricing as much as 3.8% on Fed funds by the middle of next year. Now, that's come in pretty aggressively over the first week of July here. We've come in 75 basis points on Fed funds futures, where, folks are suddenly, viewing a Fed that may, in fact, not end up being as restrictive as their guidance. But certainly when you're fighting inflation and fighting, the levels of inflation that we have, which are at 40-year highs, 8.2% or 8.6%, I apologize, which was our last reading, is a far cry from their 2% target. So I do think that the Fed is going to be on a path towards normalization. I don't think that today's Fed minutes did much to dissuade investors from, the path that the Fed seems to be on. And frankly, our call is that that's probably the right path. We do need to bring inflation down, and having some higher interest rates that are mostly priced in markets, helps us get back to a more normal footing.
And then in terms of ways to be positioned for these scenarios, is it too early to start looking ahead for the upturn, or in other words, continue to play somewhat more defensively, or is it time to say, like, look, we can see our way to the end of this process?
Yeah, so I'm a little bit more constructive than my colleague Mike Wilson, who I know is on the program often. Mike still wants our clients to be ultra defensive. For me, who spends more time with our wealth management clients, I'm more inclined to start thinking about a barbell, where certainly we have some defensive positions, but we're beginning to look at some of the opportunities and cyclicals, which have sold off really aggressively here. One of the bargains, in fact, right now, aside from financials and industrials, which we've been talking about, is suddenly energy. Many of your viewers may not have realized that literally, in the last 4 weeks, the energy sector, which has led, is now approaching its own bear market from its highs. And while, oil prices certainly have come down a little bit here on slowing demand, and some of the actions of governments to release strategic reserves and provide some supply, our view is that that's going to prove to be short-lived, as summer ultimately ebbs into the autumn and winter. We still have a supply problem globally. And energy prices are probably going to be higher for longer, especially if China recovers, as we're forecasting.
All right, so maybe a time to try and play for the turn in some cyclicals. Lisa, great to speak with you. Thank you very much.